Alpha Metallurgical Resources, ticker symbol AMR. What's it worth? Where is it headed from here? In this video, we're going to be running a valuation and also looking at some of the fundamentals to see where the business could be headed from here and what it's currently worth. So we have price per share of $327, a price to earnings ratio of 6.73, a market cap of $4.2 billion, and an enterprise value of about $4 billion. So Alpha is a Tennessee-based coal mining company. It produces low-ash metallurgical coal, which is shipped to domestic and international coke and steel producers. It has a cash debt ratio of 25.85, so for every dollar of debt, they have $25.85 to pay down those debts. Looking at their margins and profitability, we see that versus the industry, there's solid green bars, so performing some of the best in the industry. And again, gross margins, operating margins, net margins, and free cash flow all around 20, so pretty solid margins. Versus history, we can see that this is not the best they performed in history, although versus the industry, this appears to be one of the industry leaders. Their current gross is at 27.9 with a median of 14, so just about sitting between their median and their maximum for the last 10 years on gross margins. For operating margins, similar story, between their median and maximum for the last 10 years. Net margin, same story, and free cash flow as well, sitting between the median and maximum. I use these to tell me a little bit about the business, but for management I use ROE, ROA, ROIC, and ROC, and we see that for management as well, these are seriously high return with 47 ROE, 30 ROA, ROIC at 40, and ROC at 59. When we look at the price to earnings ratio, we see that their median in the last 10 years is a 4, and currently they're at 6.7, so above the median, although nowhere near that maximum of 126. And versus the industry, which they are performing one of the best in the industry, they're still ranked about 78. So with an industry median of 13, maximum of 875, and a minimum of 0.39, they're in a fairly good price to earnings spot. For trailing 12 months revenue, they have $3.4 billion. So of that $3.4 billion, they net 20%. So fairly profitable business. Looking at their financials on a trailing 12-month basis, we do see revenues growing and then sort of stagnating here. The industry could be cyclical since it's involved in coal and steel. So it's not exactly an optimal sign because we don't see revenue up and to the right, but still profitable and still fairly strong margins. And it does look like this decline slowed down and then stopped and picked back up into an incline here. Although I do see that they're earning less net income than they were in third quarter 2023 off of even more revenue, so that's not exactly what I want to see. When it comes to cash and debt, we see that they had debt, paid it off, and now they have minimal debt in relation to their cash piles. We do see significant share buybacks recently. Their operating revenue by geographic region is only the United States, so this could allow them to expand into other countries, but it also poses a risk in the event that their United States purchases declined. But to see what it's currently worth and where it could be headed, let's run a DCF. So in the DCF here, we see zero business predictability. We have no data for the earnings per share on a 10, 5, or 3 year. And for free cash flow, we have no data as well. So based on earnings per share, let's see what's currently priced in. So currently, it looks like the business is priced in at about -3 to -4% growth. So that tells me that for the next 10 years, if it were to lose 3% in its earnings per share annually, then it would be about a fair value of what it is today. So this tells me that investors are pricing this business to decline. We have a 3-year earnings per share trend line of about 80%. So there is significant growth in earnings per share, at least in the last 3 years, but there's negative 3% priced in for the next 10. So 10 years is a long time for the business, and it could slow down to much slower than 80% annualized. But I don't think a negative 3 is necessarily a realistic estimate for the next 10 years. Even if the business were to grow at 0% and stay exactly where it is for the next 10 years, it would have a fair value of 409, whereas currently we're at 327. That's only the fair value. The business could trade for a premium or a discount, but let's look at free cash flow. There's currently about negative 1%, negative 1 growth priced in for free cash flow. So if they are to even do nothing to their free cash flows and stay exactly where they are for the next 10 years, a fair value would be closer to 350, whereas currently we're at 327. So any growth above that would result in significant upside. And 5% growth over 10 years, I think it's realistic. Uh, Again, the industry could be cyclical. I don't really know. So for earnings per share, as well as free cash flow, small amounts of growth will result in fairly strong margins of safety. Looking at free cash flow, over the last 3 years, they have 191%. So there is serious amounts of growth in the business, and it looks like minimal amounts of growth priced in. So this is a fairly new stock to the market. I've been watching it for probably 6 months to a year now. But that's my take on AMR. Leave a like, subscribe, and I'll see you next time.